Silver has really had a nice little run up here, which I don't currently have anything on any of the silver futures or the silver ETF, which is SLV. Sometimes I do trade SLV.
I was looking at that this morning. I was going to ask you about that.
Mm-hmm. It's very similar to GLD, what we traded yesterday. GLD is an ETF that mirrors the gold futures. SLV is an ETF that mirrors the silver futures. So what's good about GLD and SLV and some of these ETFs that mirror the futures products, they're not really tied to the stock market anyway. They're not tied to companies, right? So when the market has a big crash, like what happened a couple of Mondays ago, that doesn't necessarily affect things like gold and silver and bonds and the euro or the yen, things like that. So it is nice to sometimes play things like GLD, SLV, TLT if you want to do a bond ETF. This essentially is the long bond.
TLT?
TLT. Mm-hmm.
Okay.
Yeah,
what do you think about the 13 delta on SLV? 7 delta, 89. Well, it's a 7 delta.
And which expiration are you thinking?
The monthly on the 59 day.
7 delta. I mean, it give you 15 cents, 14, 15 cents. You only have a penny wide bid-ask spread, so that's very liquid. So that's the good thing. Problem is this silver ETF, kind of a low price stock. So you don't, you have dollar wide strikes, but really, I wish they had like quarter wide strikes. It'd give you a lot more selection.
Okay.
But so if for me, I would 7 deltas is too far out for my taste because I would have to put on a ton of contracts to make it worth it. For one thing, remember if you're getting 14 cents for this to open this this options contract, you pay $1 fee. All right, you got the commission that Tasty's going to charge you. That's pretty standard. Typically, you're going to pay at least $1 for pretty much all brokers. Some of them charge even more than that. So you're giving up $1 of your potential $14 max profit right away. That's a huge chunk of only $14. So I got to get a bigger credit than that.
Okay.
I would go up at least to the 13 delta, but realistically, probably go to the 21 delta.
Okay.
I would probably, let's see, get 50 cents on a $320 buying power, which is fine. And then just size it appropriately, however many contracts you need to make it, worth your while.
All right.
Or you could do like I said, the 13 delta, you receive $26 on a buying power of 240. And then the same thing, you're going to have to buy, more contracts. I'd probably sell the 21 delta if I wanted to play it. And I might once the market opens here in a few minutes. I do like the fact that it has a IV rank of 71.
Yeah, so that was that's the straw that broke the camel's back for me when it comes to these gurus that go off of TA.
Mm-hmm.
And that was because I was like, I had like 98% skeptical. I still had 2% left, and that was it. I was like, these guys are clowns. They just
Yeah, it's hard to base everything off of technical analysis. Like if that is the only reason you're putting on a trade is because you drew a pattern on a chart, that's such a flimsy argument. I can't do it. I was never into technical analysis. I just never bought into it.
I'm surprised at the amount of people that have never read A Random Walk Down Wall Street.
Oh yeah, it was because it's when you talk to people that take trading and investing and just finance in general seriously, like you talk to, people, professionals in the industry, for example, all of them have read that book. But the people on YouTube, right? These guys on YouTube. That's why I say sometimes in my videos, ask these guys, have they read A Random Walk Down Wall Street by Burton Malkiel? See what they say. Or just ask them what they think about efficient market theory. See if they even know what the hell that is. If they don't, run away.
Yeah.
So we ended up quite a bit there on the close yesterday, which was nice. If you had on some bullish positions, you made money. Also, because the market has done nothing but go up. Volatility, if I go back to the VIX futures, has done nothing but go down over the last 8 days. So any short option strategies you have on, Short puts, short calls, short strangles, especially the naked ones. But even, like your put credit spreads and call credit spreads, which are overall short option strategies, short premium strategies, you made money, right? You made money from volatility coming in. And that's typically what volatility does. It tends to just go down most of the time. Most of the time volatility goes nowhere, and then out of nowhere you get one of those crazy kind of spikes in volatility, and those hurt. But then if you can get past that and ride the wave down as volatility starts coming back to its kind of normal range, you can make a lot of money if you were able to sell options when the VIX is very elevated.
Right.
I don't think I've ever been assigned a futures contract on an option. I don't take these things to expiration.
Yeah. Oh, I was going to ask you that,
options,
Derek.
Yeah. Mm-hmm.
Okay. So why is it that you see some the majority of people on YouTube that teach the will method, they teach to write a short put, get the stocks, do a covered call. But to me, doing it the way that Tasty Trade and the way you do it, it just kind of seems like it makes more sense to write a short put. If it goes to 50% before 21 DT, take it off. If it doesn't, manage it, roll it, do whatever, what you need to do.
Right.
But instead of just like being in a rotating wheel, of constantly getting stocks, getting shares, doing that. So I'm guessing you don't really like to do the full circle, do you? Like that?
I don't mind it if I go into the trade planning on running the wheel, like the NVIDIA. Like, I don't mind holding shares of NVIDIA and selling calls against it. You saw the chain earlier on. Yeah. I had a ton of not just calls, I also puts. I sold additional puts even though I was holding shares because I wouldn't mind being assigned even more shares at an even lower price. With NVIDIA, again, I don't mind having shares in that stock because it's one of the big players. Yeah. Right.
Yeah.
There's a lot of companies, though, that I sell puts on that I'm not necessarily running the wheel on. I'm just selling a put on. And if it goes against me, I'll just take the loss, roll out in time, give myself more time to be right. But I'm not itching to take shares of that stock.
Right.
The thing with the people that let it go to expiration, I don't mind the folks that do that with the covered call because you have no risk on the covered call. The risk to letting an option go to expiration is that delta risk, that gamma risk.
Right.
That late in the option cycle where the price movement really affects your P&L, and you see big swings in your P&L as the stock moves up and down. And that's no one wants to deal with that. But for a covered call, it doesn't matter because you have no delta risk or gamma risk because it's a covered call. You can't lose on your covered call. You already have the shares. But the short put, no, I never want to take a short put to expiration unless it's deep underwater and I know I'm going to get assigned the shares and I wanted the shares.
Right. Otherwise,
yeah, get out of it. Yeah.
Yeah. Okay.
Yeah. And a lot of times if you manage your positions at 21 days, you're rarely going to be down huge on a short put. It's pretty rare you put on a short put at 45 days to 60 days, and then you get to 21 days and it's, gone way against you. Usually you'll be down a couple $100 maybe, some reasonable loss that you could take if you wanted to take that loss.
Right.
Just take the loss if you don't want the shares. If you're really nervous about taking the shares, just take the loss and move on. Maybe sell more puts if you really like, selling puts in that stock. You think it's going to go back up or, For me, though, I don't like where I think the people that teach the wheel where they sell a put and just let it go all the way to expiration.
Yeah.
What they're missing is when I say like take the trade off at 50%. Most of the time I get to that 50% number way before 50% of the days have passed. Typically, when I sell a short put, I don't know if you've noticed this, but for me, I would say my average time in a trade for a naked short put is probably 10 days. I would just throwing a guess out there. Probably
Right.
less than 2 weeks, I would say. Less than 2 weeks. So
Right.
why would I put on something at 60 days and already make 50% in 2 weeks and then leave it on for
Yeah.
another, 40 something days? I'm like, hell, take my profit now, sell another put, collect another 50% in a short amount of, like, you just get more return on your
Right.
capital. You get more bang for your buck as long as you're churning those options.
Right. It took me a while to get to for that all to really click, and then once it clicked, then it all made sense. And like you just said, I had trades that I put on Thursday that I closed out yesterday, and they
Yeah.
were 60-day DTE, and they were already above 50%.
Yeah.
And like, why not go ahead and just take it and write another one, like you said,
Yeah,
you know?
most of your winners are you're going to be winners within a week to 2 at most. And sometimes you'll put on trades. I often have this happen, as I'll put on, especially a naked trade or a directional trade, so like short put, and make 25, 30, sometimes even 35% of max profit on the day I put it on, because the stock made a big move that day in my direction. And if I can make 30% the very first day I put it on, guess what? I'm taking it off.
Yeah.
Why in the hell would I want to sit in it any longer? It basically I got slapped over the head with some free money. No, just take it off.
Right. Yeah.
I still think Tesla has a lot more room to the upside rather than the downside. I don't know. Put credit spread, maybe. If I did a $5 wide, put credit spread, the 205 and the 200, max profit 170 versus max loss 330. That's my typical 2-to-1 ratio I like. I could go a little further out if I wanted to get less credit and risk more. 150 and 350 here for 200, 195. And that's all the way down at the 26 delta put. And that's actually not bad for a put credit spread. That's pretty decent.
What's on your call side?
No, I didn't do a call. This was just put credit spread. If you wanted to do the iron condor, though, I would just do a standard, like a one standard deviation. Let's see, with 175, 170, that gives you 60 cents credit, right? And then do the call credit spread the same. Hopefully, get about 60 cents credit on it for 126 versus 374. So you're risking 3 to make 1. You wanted to bring it in a little bit to receive more credit, I would probably bring the put side up, because I think, again, there's much more risk to the upside in Tesla. It's much more likely to really rise in price than come crashing back down, in my opinion. I mean, who knows? But
Right.
yeah. But the market think it's likely to go up, because you can see the one standard deviation move on the call side was a 20 delta, where it was a 12 delta on the put side. So if I did the 180, 175, and then on the other side, the 275, 280, that would be 140 versus 360. If you're really worried about collecting theta, it's just not enough of it way out.
Okay, so theta here, looking at Intel, would be is one point
$1.
$1. Okay, all right. So that means it's gonna move $1 either way.
That means tomorrow you should make $1 from theta. From that with a passage of 1 day in time, that's your opening theta. You make $1.
Okay, and the Vega.
And then the next day you will make another $1. Actually, theta increases as you get closer to expiration, so theta will slowly rise, but your opening theta is $1, and it's only going to increase over time. So,
okay, all right.
So you're always going to make at least $1 every day just from theta on that trade. That's basically how that works.
Okay, I love these small trades like that.
Mm-hmm.